What is up, guys? This is Chris with Leveling Up Your Finances, and let's consider this video part 2 of the guide to investing for long-term financial wellness. Basically, that other video was getting pretty long, and something came up and messed it up, so I'm just going to do the second half right now. Since it is a little bit more in-depth anyways, this will be considered part 2, and let's just get started. Which type of investments are right for me? Right types of investment match your goals, risk tolerance, time horizon. It really depends on how many years you want to invest, and no single option is right for anybody. Then you just jump down all this other stuff. You don't care about any of this. So what are the pros and cons of the common investments? Stocks is the biggest one, obviously. That's like the number one everyone thinks about when you talk about investing. Stocks represent actual ownership in a company. Buying stocks gives an investor multiple chances to make money. In addition to being paid annual dividends, you can sell your shares on the stock market. If the value of the stock has increased since you originally purchased it, then you can turn a profit. That's the ultimate goal, get that appreciation in your shares. Plus, if you can get a dividend, that's kind of nice. It's always nice to get money. Great returns aren't always guaranteed. Look at the stock market right now. A lot of people are buying high and selling low at the moment out of fear. So you're having great losses, not great returns. So definitely not a guarantee. There's thousands of publicly traded companies out there, and not all of them are going to be success stories. Performance of a single stock is contingent on the performance of the company and will rise and fall with the success and failure, respectively. A single stock is one of the most risk-filled investment choices. Stocks are an investment for people with long time horizons and high risk tolerance. Owning multiple stocks diversifies this risk, but it does not guarantee a profit again. All right, guys, remember bonds. Bonds are basically you're owning a piece of debt. Bond investing lets you act as the creditor to companies, governments, municipalities. I don't even know why I can't say that. Consider a relatively low stock investment, but some are riskier than others. They do grant you a stable income, and that income is derived over a fixed term set at a time of issuance. It is really early morning, and my coffee is not kicking in. I apologize. I cannot speak. I can't English today. All right, mutual funds. Again, I don't really recommend mutual funds. They're kind of old, but you guys do whatever you want. If you're Dave Ramsey fans, go for it. Who cares? Mutual funds are ideal for those who want to make money without getting caught up in the details. Instead of having to worry about whether you are picking the right securities, you can just choose a fund that groups them together on your behalf. They're usually easy to find a money manager. Choosing one with a track record of generating profit or profitable returns can be trickier. So again, remember, you're going to be paying more fees and stuff like that. It's like a third-party person's managing your funds. So usually the fees are a little bit higher when you can just do something like an index fund, which does basically the exact same thing for a lot cheaper. Index funds, instead of depending on third-party managers to research and select securities, investors rely on the fact that each index fund follows a particular market index. It's a form of passive investing. Indexing reduces the expense associated with maintaining portfolio assets. These funds also tend to outperform many mutual fund investments over the long period of time. Again, that's why I recommend them over that. But don't take financial advice from an idiot on YouTube. Interesting fact, Warren Buffett recommended index funds as one of the better retirement investment options. So basically, if Warren Buffett tells you something, you should probably listen, especially when it comes to investing. That man is very wealthy because of his investments. Exchange traded funds. This is one I really prefer and actually like a lot. I use it for most of my investing would be through exchange traded funds. They offer more flexibility because these exchange traded funds get bought and sold on the stock market. With the mutual fund, transactions are pegged on a daily end of trading prices. With exchange funds, you can capitalize on the fluctuation depending when you sell. So you can buy exchange traded fund or ETFs throughout the day versus mutual funds, which usually are bought or sold at the beginning or the end of the day. And again, exchange traded funds usually have a lower expenses than mutual funds do. Stock options. Again, very risky. If you don't know what you're doing, you probably should not be doing stock options. This is not for beginner investors. When you're buying a stock option, you are buying a contract. This contract gives you the right to trade a certain number of stock shares, usually 100, at a specific date and time. The goal of the stock option is to outguess the market or hedge price movements. You either want to buy a stock for less than it's worth or sell it for more. You are not obligated to complete the deal, although you will lose what you spent on the options contract or whatever the premium was to buy that contract. IRAs and 401ks. An IRA, an individual retirement account, is a good way to plan for the future and capitalize on various benefits. Traditional IRAs let you deduct contributions from your taxes, and investing in Roth IRAs lets you make transactions without incurring tax penalties. So traditional IRAs basically is when they take money, pre-tax dollars, and then they invest it for you. But the thing is, you will pay the taxes when you withdraw that money later down the road when you retire. Roth IRAs, however, you're investing money that was already taxed. However, when you go to take that money out, withdraw it later at retirement, you were no longer taxed at that point. So it grows tax-free that entire time. That's why if you're in a lower tax bracket, most people say get the Roth IRA. If you're in a higher tax bracket and you want to lower your tax bracket, possibly, you can use a traditional IRA. So it's kind of fun. Those are just kind of fun little tips on those. Anyways, 401ks is a form of IRS recognized pension account where your employer provides or matches your contributions. Contributions come from your paycheck before you receive it, and you do not pay taxes until you withdraw the money. So it's very close to a traditional IRA. As with most retirement accounts, you can only withdraw under certain conditions. Again, everything's a little bit different, so you have to look into your account specifically. A lot of times if you withdraw early, you have to pay a penalty. Real estate investment and home ownership. Put money into stable assets in the hopes that they will appreciate over time. Again, real estate can be anything. It could be a house, apartment complex, commercial buildings. It could be land. Real estate investments come with unique risks. Events like housing crisis or economic downturns can take large amounts of your cash flow. Real estate doesn't always go up, by the way. That was a big myth about 15 years ago, and look how that happened. But now, 15 years later, real estate just keeps going up. But take that as you will. Eventually it'll go down again. Maybe. Supply and demand's a crazy thing right now. Okay, so now we're going to jump into how to start investing. You have two options, basically, guys. You have a self-managed investing account or a professional managed investing account. Self-managed accounts, well, you would be doing this yourself, since it's in the name. If you want to have control over your accounts, you are not alone. Be sure to choose an investing platform that saves you time, shares your mindset, and offers you flexibility you need to manage your money. So again, you are managing it. That's why it's called self-managed. A professionally managed account, taking a hands-off approach. So this is if you want to just not have anything really in it. You may talk to your manager, a professional manager, your CPA or whatever it is, a financial advisor, every so often, maybe once a year, maybe once a quarter. But basically, these people invest your money for you. Some people find that working with a professional keeps them disciplined and gives them peace of mind that they're over their investments. So basically, you're not watching your investments, someone else is. So I could see the pros and cons for both. I personally I'm kind of a nerd, so I like to look at my accounts often, and I like to manage it myself. Would I get better returns with a financial advisor? Possibly, but we can always go into that. Do you need a financial advisor? We can always do a video specifically on that. Not necessarily. Most people probably don't, unless they just don't have time. All right, so you're going to build your investment portfolio. Let's just skip all this boring stuff and get right into it. Well, number one, you're going to start by opening an investment account. Pretty obvious, but that's number one. All right, 2, roll over any accounts, your old accounts. So you can do this, say, with your retirement accounts. You stopped working at a company and you had a 401k with them. You can roll over your 401k into another account, usually. You don't have to do this. You can always let it ride, but sometimes it's just easier for people to have all their stuff in one area. That way it keeps them less confusing and you don't forget about anything. Number 3, connect your savings or checking account to an investment account. 4, choose your investments and allocate your money in your portfolio. And then 5, automate as much as possible for transfers, auto investing, and savings. I definitely like the automation part because it's set it and forget it on a lot of my actual investment accounts. That means I don't have to think about it. I can just go check it once a month, once a week, once a quarter, whatever it is, and it's done. It just pull money right out of my account and just throws it in and invests for me. So I don't have to try to time anything. And then maintain your investment portfolio. Create and maintain a balanced portfolio. You can diversify your investments according to your objectives and goals. This means reviewing your investments and rebalancing your portfolio as necessary. Many investors do financial checkups quarterly or annually. Again, if you're not going to really be hands-on, quarterly and annually is great, especially for just a rebalance. I don't really rebalance ever because I just let them ride most of the time, because that's just how I am. And then disclosure, guys. So this is M1 Finance's disclosure, but basically they're not providing any investment advice, blah, 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 any of that. Same here. I'm not trying to give you any advice. Never take advice from an idiot on YouTube. You need to do your own research and due diligence. I'm just trying to give you guys a little bit of overview and the basics of investing and all that type of stuff. And I do share some of my own personal stuff, but again, that's my personal stuff and my personal opinions and things that have worked for me in the past. Doesn't mean it will work for you in the future. But feel free to ask me any questions you guys got. Comment down below and let me know. Also, if there's anything, a topic you want me to cover, just comment down below and let me know, and I'll try to get to those videos, because mostly lately I've been stuck on crypto, but I love finances as a whole, not just crypto. At the end of the day, guys, remember to stay awesome and keep loving each other. Mwah.